You're turning 73 years old soon, and you're wondering about this magical thing called RMDs. What are they? How do they impact my life? And what do we need to know about that? That's what we're going to look at in our video today. Hello, I'm John Vandergriff. I'm one of the owners and the wealth planning team lead here at Blue Ridge Wealth Planners, where we help people answer questions about retirement planning as a whole, but specific parts of it are key parts of a well-rounded retirement discussion. RMDs are no exception to that. So we're going to get into this. And the first question that we have to answer is, what is an RMD? Because we use this term, I will use it a lot in our video today, but very clearly we want to establish that on the front. A RMD is a required minimum distribution. You say, okay, that's what the letters mean, but what does that mean in terms of how my relationship may change with the money that I've put away? So again, when you reach the age of 73, this has been an age that has changed over the last few years with different rule changes going back to the Secure Act in late 2019, early 2020. When you reach RMD age, something changes between you and the money that you put away in your retirement account. So whether it's a 401k, 403b, IRA, TSP, any of these tax-deferred positions that you have, you are now in a position where if you have not taken any distributions to that point, you are now on a schedule where you have to take out a certain amount of money each year based on the value of those accounts, and that's going to be a thing that will change every year. It's not a set number. It will be something that, you know, as time passes, and we'll show you what variables go into this, you must start taking those distributions each calendar year by December 31st, so that you can satisfy the required minimum distribution. Now, the initial age at 73, they give you a little bit of wiggle room here. You can actually push forward that very first RMD until April 1st the following year. The issue with that is if you do that, you will actually have to take two required minimum distributions that year, because you will have the one for age 73 and then also the one for age 74. Now, when we talk about required minimum distributions, one of the things that's important to point out is what happens if you don't do this? Well, this is where the government imposes the stiffest penalty that they have if you do not satisfy the required minimum distribution by either the April 1st time frame at 73 or afterwards, December 31st each year. You will have a 50% penalty of what your required minimum distribution was supposed to be that gets paid to the government, and you will still have to fulfill the required minimum distribution. So pretty stiff charges there if you don't do this. So this is why we want to pay attention to what an RMD is, when does it have to come out, how does this interact with the money that I've put away. Now, as we look at this, one of the things that's important to understand is how is the required minimum distribution, or RMD, calculated. And so what they're going to do is they're going to take all of the different retirement accounts that you have and add those together and see what their value is on December 31st of the year before you start required minimum distribution. So if you turn 73 in the year 2023, your RMD is set on the value of your accounts on December 31st of 2022. So again, that is the place and time where the RMD value is set as far as what they're dividing it into. And then they're going to divide your age component into that figure to determine what percentage you are required to take out. And that is a percentage that changes every year as we look at this chart. This was the updated requirement minimum distribution brackets, or actuarial tables as we look at it. They went in place in 22 whenever RMD started at 72. Again, we do not have required minimum distributions at 72, so we can just kind of mark through this. So at age 73, you divide that total sum. So if you've got $1 million in retirement accounts, you would divide that by 26.5, and that would give you roughly 3.77%. Now the exact figure is going to be this number divided into $1 million. But if you took 4% out, that fully satisfies your RMD. You just have to take whatever this number is or higher out during that calendar year. Another important distinction to point out is sometimes people will ask the question, well, if I turn 73, do I have to wait until I turn 73 to take out my required minimum distribution? As long as you take that during the tax year that you turn 73, you do not have to wait until that date. That would be unfortunate for people whose birth dates are in the month of December or maybe between Christmas and New Year's Eve. You would have a crunch on your hand that may not be satisfied. They don't put that time constraint on you. You can do it any time during that calendar year. It will check the box for that required minimum distribution. So, and again, as you hear me say that, you see why we talk about this as RMDs instead of saying required minimum distribution over and over again. So again, as you age though, you notice that this divisor goes down, which means the percentage of the account that you have to take increases. So again, the longer you live, you notice that this jumps from a little less than 4% to at 80, you're at almost 5%, 90, you're at over 8%, 100, you're at 15.6%, and then if you max out at 115 plus, you're taking out over a third of the account every year for as long as you're here. So it may not be very much, but it is a more substantial amount of money that you're forced to take out as time progresses. Now, one question we get a lot, what happens if I'm still working at the age of 73? Do I have a required minimum distribution owed? Well, RMDs are actually pushed forward, so you do not have to take these distributions while you are still working on the current 401k that you have. So if that's the only retirement account that you have, you do not have to take required minimum distributions as long as, and that's an important distinction, you do not own 5% or more of the sponsoring company. So if it's your business that you run, you own a third of it, and then you are at 73 and you're wondering about RMDs, you will have to take RMDs on that current plan that you're in, as well as any other retirement accounts that you have outside of your current sponsored plan. But again, if you're someone who works for a large corporation, you have no ownership in it, you will not be required to take it from this specific account, but any other retirement accounts that you have outside of this current 401k will have the RMDs that need to be satisfied during that calendar year as you move forward. So it's important to recognize the distinction there, but notice that you could have one account that's big or small as far as the percentage of your total assets, but we don't want to forget about these accounts even if you're still working. Now, one question that people ask often is, well, if I'm forced to take this money out, can I just take it out, pay the tax, and then put that into a Roth IRA? And again, this is not my rule, this is the government's, so don't shoot the messenger here. The required minimum distribution that you are forced to take cannot be put into a Roth IRA position. You would say, well, what's the difference in this and me converting it? Basically, the difference is you're voluntarily doing the decision to convert those dollars versus the government forcing you to take those distributions and pay the tax. Now again, we're splitting hairs here. These aren't my rules. You still, though, even if you're at 73 or higher, have the ability to convert some of these IRA dollars to a Roth. The key, though, is you have to satisfy the RMD first. So you've got to take out let's say it's $20,000 you've got to take. You have to take that $20,000 out first. Then if you want to convert additional dollars on top of what the government makes you take out, you're welcome to do that and pay the taxes like you were able to before required minimum distributions. It's just now you have to take that out first. Some people say, well, can I use that money to pay some of the taxes? Sure. Take that distribution out, satisfy the RMD, then do your conversions, and it can be, functionally useful in that journey. And again, if you say, well, what are Roth conversions? Again, we can talk about that in another video. So as we look at this, one thing that is important, because when you get to RMD age, you may be in a position where you don't actually want or need this money, which again, there are a lot of people that would be willing to take it. If you are already charitably inclined and giving money to a charitable institution or a 501c3 organization, one important thing to be aware of is what's called a qualified charitable distribution, or what we refer to as a QCD. So once you reach the age of 70 and a half, which is where RMDs used to be for a long time, they've moved that age, as we said, up to 73. You can give up to $100,000 out of your retirement account to a 501c3 charity with no tax impact. You say, well, John, I don't have any tax impact on charitable gifts now. I'm going to show you the distinction on the next page here. But any money that comes out for a QCD does satisfy the required minimum distribution, or RMD, that you owe for that calendar year, or at least a portion of it, whatever you give. So if you've got to take out $20,000 and you're wanting to give 10 of that to a charity, if you do it through a QCD, that will not register as a tax impact to your 1040. You're still able to satisfy and check the box for the RMD and have hopefully a more efficient picture here. The key to this is that it must be given from the custodian who's holding your retirement assets to the 501c3 charity directly. So it can't come to you first and then you write a check. Really, it's got to be given directly to them so that you avoid it showing up as a taxable event. So what does this look like? Well, let's look at the non-QCD route. So let's say you've got $100,000 of income. You may have more complexity to your situation. I'm just trying to give you a very simple example here to see the impact here. So let's say you've got $100,000 of income before you are taking a required minimum distribution. You are required to take $10,000 out. You give that entire $10,000 to charity, but because your standard deduction is $30,700, you don't get any credit for this because you have not given, and all your deductions are not more than what the government is already giving the standard tax filer. So what the government does is they take the total here, which is $110,000. They take $30,000 of deduction off of it, and so your taxable income after adjustment is $79,300. Well, if we do this exact same thing, but we utilize the QCD instead of just taking the RMD out and then giving it later, we still have $100,000 of income. We take the QCD, give this money directly from the custodian that you have to the charity. So I've got these brackets around it because you are satisfying the RMD. $10,000 is leaving the account. However, it's not adding to the $100,000 of income that you have, which means you don't have an increase on your income and you get the full benefit of the standard deduction that the government gives. So they take $30,700 off of $100,000 instead of $110,000. So after deductions, your taxable income is $69,300 instead of $79,000. So again, that's the benefit of a QCD. The key here is this money that you want to give to a charity? If not, it's a pretty steep tax rate to give away 100% of your money instead of paying taxes on it. So I'm all for charitable causes, giving efficiently. This is a way that hopefully you can give money and accomplish the purposes you want, but also be in a more tax efficient position. Now, one question we get a lot is, where do I take my required minimum distribution from? And there's an important distinction here that we have to look at between an IRA and a 401k. So if you have money still in 401ks, every 401k is required to send out the required minimum distribution percentage from their bucket, as if you don't have any other accounts. So if you have 4 different required minimum distributions, you have to take out, let's say, 4% from each. You have to take 4% from each account, regardless of how they're invested. And again, not 4% of the total, 4% of that particular bucket. The difference with IRAs, if you have all of your money in individual retirement accounts, it's the collection of the IRAs that they look at, and you can technically take that total amount from any of the buckets and leave certain buckets alone. So as we talk about investments being in maybe a growth position, an access position, or a protection position, let's say you're in a position where the market's down in value, like a 2008 time frame, where it's a major loss and you don't want to take money from a very aggressive position that's down in value. Well, if you're in a 401k that's only got stocks, the government's going to make you take that RMD out by the end of the year, regardless of how it's invested. If you have an IRA, you may not want to take it from your most aggressive positions. You may choose to then sell some things that are safe, be able to satisfy the RMD and not have a negative impact to the way that you invest this money. On the flip side, let's say we're in a year where the market is good and you want to be able to take all of your RMD out of gains from the stock market. You may choose, if you have IRAs, to take the entire balance out of your growth positions and leave some of your more conservative positions alone during that particular year. So what we want to point out here is it's good to have diversification in your investments, not just for different investment returns, different levels of risk, but when the government forces you to start taking money out, the more options you have to pull from typically gives you more flexibility and the ability to make hopefully a good decision when you pull that out. So as we look at this, the question becomes, well, how do I organize this? You know, RMDs are a key component of really 3 different of the 5 different conversations, maybe really touching all 5, because obviously this is going to impact your income. If you're already drawing out of your accounts, RMDs may not be a noticeable event, but it's still important to plan our income. It can impact, as we just looked at, the way that you invest your money. It's going to have an impact on the taxes that you have, especially if you pull it out as a RMD instead of a QCD. Healthcare can be affected if we increase our income to a certain level where now Medicare starts to get more expensive. And then family legacy. The reality is, if you don't take all of the money out of these retirement accounts, someone's going to have to pay the taxes on it. Maybe you in your lifetime, it may be your beneficiaries. So again, we see RMDs really have a pulse in all 5 of these areas. And if we're not getting planning and seeing the impacts of that, that's something that I think is very important. So if no one has ever walked you through a full picture plan, we'd love to sit down with you and see if we can help you make hopefully some good decisions about how and where, and answer any questions you have about RMDs. But again, as a part of a larger discussion of what needs to happen, what goals you have, objectives, and then how does that filter through the different areas that we look at to help you hopefully have a great retirement picture both today and moving forward. So click the link below this video. It'll pull our calendars. We'd be happy to sit down with you, take you through this discussion, and then single out and answer any questions that you may have. If you have any specific questions about this video, please leave us some comments below so that we can engage with you and see if we can clear up some things that may be confusing. So that's all I've got for today. Thank you for your time. We look forward to giving you more content like this in the future. So if you're not subscribed already, do that. Share this video with other people. We just want to help as many as we can enjoy their retirement.